Alright guys, good afternoon. So I want to recap the trade that I took this morning. In London, it's very much the same bread and butter setup, and you're gonna see that the setup really is the same every single time. Not much about it changes. It's the same framework, so we look for a liquidity grab, then break of structure, and then a retracement into a fair value gap in premium or discount, depending on exactly what we're looking for. Okay, so today I had a bearish bias. I was looking for sales because, as you know from last week, well, from yesterday, sorry, I wanted to see price react of this fair value gap, but it didn't. It traded all the way through it. So since it traded through here, I actually wanted to see price take out this low, which it did, right? Price did ultimately come out and take this low out, and that's exactly what I was aiming for in the London session. Now, as you can see, the setup started with a very shallow break of structure, but this was much more animated on my broker. So different brokers can give you different feed, and what's most important is the broker that you're actually trading with. So I'm trading with the broker of the funded account, my Forex funds. So this push up was much more animated on my broker. That's why I ended up seeing it. So as you can see, the high of the candle, you're gonna see it up here. The high of this candle is 1.06, 1.016888, and the high of this candle, it basically shows the same. Now let me show it to you on another broker, because I have multiple brokers over here. Let's look at this one. This is GU. Alright, this should be the same highs, 1.0688, and then this one says 1.01689. Now this is the broker that I actually use to trade on a daily basis, right? But just for the sake of taking off all these markups, I use something different when I'm showing it to you guys. Alright, so let's get back to it. So we had a liquidity grab, then we had a break of market structure. So the market came down and we had a body close below this. Now over here we can see that we do have, excuse me, over here we can see that we do have a fair value gap that is in discount. So price runs back up into a discounted range, and then you can see this golden line here. So let me explain this to you. So what I do to actually place my stop loss, because you need to put a stop loss on when you're trading, I'll place my stop loss above the highest fair value gap I can find between the 5-minute and the 1-minute time frame. So if we start going down time frames, we're gonna see that the 4-minute has no fair value gap. The 3-minute, which is where I got this fair value gap from, you can see that it is higher than the 5-minute fair value gap, and this candle is actually the high of the entire move. So because it is the high of the entire move, I just use this, right? So my stop loss would have been above here. We wouldn't have gotten stopped out. We got very close to it, but we didn't actually get stopped out. Price did not move extremely fast away from the point of interest. You see, we had 5 minutes, we pushed down, we came back in, we pushed down again, pushed down again. But at the 3 a.m. open, we got pretty animated, right? Because this is all pre 3 a.m. 3 a.m. is when the bells ring for London. This is 8 a.m. London time, right? Now at 3 a.m. when the bells ring for London market open, we always have some animated price action. That's when some serious liquidity comes into the market, and you see that it took us almost directly to our target, and then the next trade took us down into it. Boom. Now this was gonna be a very short video, but since we're already here, I'm gonna show you how this strategy basically works on different time frames. You may not have to use the exact time frame that I'm using. It works on any time frame that you choose. So a bunch of my friends actually commented and they were asking me about using the 1 minute. Now I don't like using the 1 minute because it's very choppy. It's, you have a lot more price action in there, a lot more swings. That's why I prefer not to use it. But if you did want to trade off the 1 minute, as you can see, the high was taken here, then we broke down. We broke the lows here. The lows were broken here, which means that you could have taken your entry right here in this fair value gap. And then when taking your entry here, you have to keep in mind that you have a fair value gap up here, right? You have a fair value gap up here. This candle would not be part of your fair value gap. So if you use the 1 minute alone, you would have actually got stopped out. Like there's no way that you would have hit target, right? But if you did do what I did and actually go up, see where the fair value gaps are on the different time frames. If you use the 3 minute, you would have noticed that hey, this entire candle is actually holds a fair value gap. You put your stop loss above this candle, right? 1 minute entry, and then you're aiming for the same thing. So you shoot all the way down for our sell side liquidity target. Could have netted you 4.5 risk to reward, right? This is just an example of a 1 minute setup. Now, after the sales were done, I actually looked for buys because since the market took out sell side liquidity, I was hoping to take out buy side, but the buys didn't work out as planned. I was looking at this breaker structure here, right? The market broke higher, we left behind a fair value gap. I had an entry in here, but I eventually got stopped out when the market traded below these lows because my stop loss was below these lows due to this fair value gap. Okay, now over in New York, I did see a setup. I didn't trade it as you guys know. I don't really trade New York, but in New York we had a buy setup. So as you can see, we have this low created between 5 and 7. New York starts from 7. New York kills on the 7 to 10, right? So we had this low created. The market went up, created another low. So now these are relatively equal lows. It went up. At 7 a.m. we created exactly equal lows. Then we came up again. We tapped there one more, and then we finally broke down through. So now I will be looking for a break of market structure after after the liquidity grab, right? So if we take it off the 5 minute, you can see that we have a break of market structure right here. This candle would have actually broken market structure because this is just a wick. I like to use candle bodies. I find candle bodies work better for me. It's from my own backtesting and my own trading. You can look at whatever works best for you from your backtesting and your actual life market experience. You don't have to follow exactly what I do, right? So you could have taken a trade right here. This is your fair value gap. Price traded all the way up here. Now you may be wondering, do I even know if the market is in a premium? And yes, it is. I do know because I was looking at it. So you see, the market is smack dab. Market traded back down into a discount before buying up, right? You could have targeted these highs, and even highs over here, right? Potential session liquidity. Don't mind this. This was for London. In case London wanted to buy, this would have been my overall target for the day, right? So on the 1 minute, like you guys requested, on the 1 minute, we'd be looking at the market taking out the lows here. Then we have our break of market structure right here, and the break of market structure left behind a fair value gap. These are the best ones to trade when you have a break and the break itself is a fair value gap. So you would have been in the trade here. You would have had to weather some taps into the fair value gap. So you have to have strong mental in here. Otherwise, you just probably close out your trade or partial out your trade, or maybe even get stopped at that break even if you're not patient. You have to keep trust in your model, in your entry, and then eventually you would have gotten this entire move up, right? Now, the 1 minute may get you in earlier, but I would say that it's for much more experienced traders and traders who practically don't want to take their eyes off the chart after a potential liquidity grab. Because what could happen, and it has happened, it can happen at any point in time, even though that you thinking, okay, I want to sell. If the market wanted to buy, it could have done this. We could have just had something like this, and then a continuation, retracement, continuation, retracement. Now on the M5, it would look like this, but on the 1 minute time frame, which has much more fluff, it will look like this. So your market is going up, then the market goes down, and you'd have breaks in market structure going down. So you may end up taking a sell that gets stopped out where you lose, or you get stopped out at break even. Then you go up again, and you get another. Then you have some more again breaking market structures. You're trying to sell, and you lose again. So it's really up to you. I like to keep my I like to keep my losses minimal, which is why I stay on the 5 minute. Hope you guys got some insight from this, and I'm gonna see you hopefully tomorrow if we get anything in the markets.